Meeting is called to order. We'll begin with the minister oath of office by clerk, starting with Jason. David Cohill. David Cohill. Okay. If Jason has an excused absence, we'll start with David Cohill. Congratulations on your reelection. You can go over to the clerk.
Please meet me up here and raise your right hand. I, David Cohill, do solemnly swear or affirm
Do solemnly swear or affirm
that I will support the Constitution
that I will support the Constitution
and will obey the laws of the United States
and will obey the laws of the United States
and of the state of Florida,
and of the state of Florida,
that I will in all respects
that I will in all respects
observe the provision of the Charter
observe the provision of the Charter
and ordinance of the City of Jacksonville Beach,
and ordinance of the City of Jacksonville Beach,
and will faithfully discharge the duties
and will faithfully discharge the duties
of Pension Trustee of Police Officer Retirement System.
of
Pension
trustee
Trustee.
of the Police Officer Retirement System.
Congratulations. Next up, Ed Dawson, reelected by members to the Firefighter Pension Board. Congratulations.
Same thing for you. If you please raise your right hand, sir. I, Edward Dawson,
I, Edward Dawson,
do solemnly swear or affirm
do solemnly swear or affirm
that I will support the Constitution
that I will support the Constitution
and will obey the laws of the United States
and obey the laws of the United States
and of the state of Florida,
and the state of Florida,
that I will in all respects
that I will in all respects
observe the provisions
observe the provisions
of the Charter and ordinances
of the Charter and ordinances
of the City of Jacksonville Beach,
of the City of Jacksonville Beach,
and will faithfully discharge the duties
and faithfully discharge the duties
of Pension Trustee
of Pension Trustee
of the Firefighter Retirement System.
of Firefighter Retirement System.
Sir.
Congratulations, Ed. Welcome back. Thank you to everyone who was able to be here today. We have let's do a roll call, Madam Clerk.
Nick Curry,
Here.
Dan Jansen, Christine Hoffman, Brandon Maresma, Eddie Vergara,
Here.
David Cohill,
Here.
Marvin Dupree,
Here.
Rudy Dean, John Gostilla,
Here.
Jason Sharp, Gaylord Candler,
Here.
Ed Dawson,
Here.
John McDaniel, Lance Huish,
Here.
Debbie White.
I jumped the gun. We have a quorum on all three boards. Congratulations, firefighters, winning. It is a contest. We will move on to approval of the minutes. Can I get a motion to approve the August 9th, 2023 quarterly pension board meeting minutes? Is there a
Motion. Cohill.
Is there a second?
Second.
All in favor, signify by saying aye.
Aye.
Any opposed? Motion carries. Courtesy of the floor to visitors. Any visitors wishing to speak? Okay, seeing none. Legal update. We have Pedro on the phone. It's all yours.
Okay, trustees, good afternoon. Can everybody hear me okay, hopefully?
Yes.
If not, just let me know and I'll try and speak up as much as I can. And my wife already tells me I yell when I speak, so it shouldn't be that hard for me. Just a couple things to go over with you, and hopefully you've had a chance to look over some of the materials that we sent over maybe about 2 weeks ago now, I think at this point. But this is really everything in reference to what was formerly known as House Bill 3, which is now, as of July 1st of this year, known as Chapter 2023-28. And this is the statutory amendment that was enacted this most recent legislative session, which defines or amends the definition of a fiduciary to now, in addition to including acting solely in the best interest of participants and beneficiaries while deferring reasonable expenses, it now also requires that trustees, fiduciaries, when making investment allocation decisions or proxy voting, focused solely on quote-unquote pecuniary factor. And a pecuniary factor is essentially defined as directly affecting either risk or return, right, and or return. And then the statute goes on to further prohibit the use or the furtherance of any type of political, sociological, ideological, religious goals, right? And so taking a step back, if you guys recall, this really all stems from summer of 2022, the State Board of Administration, which is responsible for several asset pools in the state, it's the Board of Trustees, similar to yourselves, and a three-person Board of Trustees, the governor and two of the governor's appointees. And amongst other asset pools, right, they're responsible for the state 529 account, responsible for the unclaimed property fund, obviously the treasury, but the state, primarily, or the largest pool of assets that the state is responsible for is the Florida retirement system. So there was a disagreement, difference of opinion between the SBA and BlackRock specifically over its use of ESG, that moniker, environmental, social, and corporate governance factors, when it was not only constructing its portfolio, but also in the manner in which it was voting proxies, right, on behalf of the assets that it was managing. So they ultimately divested a portion of their assets from from BlackRock, from the manager, and adopted an administrative policy, right, this pecuniary factors administrative policy. Fast forward to the legislative session this year, earlier this year in April, and that administrative policy was essentially codified, right? It was used as the basis for this new statutory amendment. So once the bill was signed by the governor, the SBA actually made a fairly large commitment to, ironically enough, a BlackRock ESG fund. And so obviously the questions came pouring in. How does this comport with not only the administrative policy, but also the law, which admittedly back then didn't become effective. He signed it in May, right? Didn't become effective until July, but obviously nobody really understood how this was not in conflict with the new amendment and with the SBA's prior position, right? And I think that the governor's office, the response is telling or insightful in a way, and essentially, and I'm paraphrasing, but the response was something to the effect of this fund has always had excellent performance, very reasonable fees, and all of the risk metrics satisfied the board's long-standing tolerance, right? Tolerance threshold. Essentially pointing to these pecuniary factors, right, as the basis for the decision. And so, while certainly that's not official guidance, I think it did put a lot of folks at ease to the extent that the law really seems as though it's geared more towards legislating intent rather than a final decision. And so what I mean by that is it appears that a fiduciary can invest in whatever they want, right, whether it's ESG or not, provided that the basis for that decision, the reasoning for that decision is solely based on pecuniary factors, right, risk, return, standard deviation, alpha, beta, right? all those empirical data points that you guys review as part of your quarterly performance report, right? Now, conversely, if you were to take that same ESG fund, but the fiduciary's reasoning basis for making that investment was this is a really good fund to help curb global warming, or does a lot to save the whales, or it really protests the war in the Ukraine, right? That would seemingly be a breach of your fiduciary duties, an impermissible use of your duties and allocation of assets and public assets in conflict with the statute. So, ultimately, I think this is going to be, much to do about nothing, hopefully, other than, the couple extra hoops and hurdles that we have to jump through. But I think from a practical application, right, it's not going to change the way the boards operate. It's not going to remove or limit the universe investment universe that the board have at their disposal. So, I think ultimately it's not going to have too much of an effect, but obviously we do have to discuss it, unfortunately. And one of the requirements of the statute is that we file a compliance report, a biannual compliance report every other year, beginning this year, December 15th of 2023, and then obviously subsequently every odd year thereafter, we have to file this report. So what we did was, since the state, the Division of Retirement was supposed to issue a rule, which it finally did in early October. Unfortunately, the rule was not very helpful or insightful in terms of what the report should look like and what the state is looking for in terms of compliance. We essentially got together with some of our other pension colleagues around the state and drafted and created this template report, which we believe satisfies the requirements, right? So we're going to, in addition to that report, which is really a series of, if you guys are taking a look at it, it's a series of permanent statements, really, and referencing the boards, the respective boards' investment policy statements, which obviously are the governing documents, right? The operative documents when we're looking at investments and asset allocation decisions. So the thought is to file that template report along with the investment policy statement. And we did have discussions, I have had discussions with Keith at the state, and obviously he can't give me a formal blessing, but it seems like this should suffice for purposes of our reporting requirement on this. So hopefully this will be it, but obviously we'll wait and see what the state comes back with, and we'll adjust accordingly. And then certainly the next time we do this, we'll should go a lot smoother, should be a lot less, at least administratively burdensome. Everybody will kind of know what's inbound and what's out of bounds. But this isn't the first time everybody's doing it, and really there's no other report like this anywhere to kind of try and use as a model. Everybody's really operating with a blank canvas here. So again, hopefully this should suffice, but if not, we'll obviously work with us and the staff to make sure that we get whatever we need taken care of. But let me take a minute there. Does anybody have any questions or anything on kind of the material that I presented and what we're going to be doing in December?
Hey Joe, this is Dustin. In the email you sent, it said that either the administrator or the chairmen of the board could file the paperwork. Do they need to do anything to authorize me to do that for them, or do they need to? Yes. So that's what I was going to get to. Thank you, Dustin. So, and again, this is more, I think, in the interest of just memorializing, right, crossing our T's and dotting our I's. But what we're having each of our boards do is essentially make two motions. The first motion would be to authorize Dustin as your plan administrator to go ahead and file this report. And the report is going to be filed in the same portal that the annual report is filed on. My understanding is it's different drop-down selections. So, the one good thing I guess the rules did was it told us where to file the report, but other than that, it wasn't very helpful. But if the board is comfortable with that, then we would certainly recommend that be one of the motions that's made. We'd be authorizing Dustin as your plan administrator to go ahead and file a report on your behalf.
I thought you said there were two. Did you say there was a second item, a second piece of action? That we need to
Sure.
do?
Yeah, absolutely. Sorry, I didn't know if you guys wanted to do that first. So the second item is, excuse me, part of when Dustin's going to go file the report, before he can even submit it, it's going to include, he has to check a little box, right? It's essentially an affirmation that the board is in compliance, right? And so it's very similar to, whenever you've been filling something out online and they ask you to check the box, the I agree to terms and conditions box, right, before you can kind of proceed. Similarly, the portal, the state portal has a similar attestation. So what we're having the board do, really for two purposes. First, obviously it covers, in this instance, it's Dustin but it covers whomever is filing the report on behalf of the board, and just in terms of having the board's authority to do this. But I think more importantly, what it does is it will underscore, highlight the fact that the board obviously is aware of this, and is certifying its compliance with the new statutory amendment. And so what we're having the board, just so we have this part of the record, is that each board pass a motion effectively attesting to the motion would be to confirm the board's compliance with Chapter 2023-28 and authorizing the filing of the pecuniary factors report accordingly, subject to final legal approval. So those would be the two motions. Again, probably redundant, certainly overkill, but we just want to make sure that we have it as part of the record, as part of the board's action, just in case we need it. But, again, I suspect we won't, but just in the lawyers love paper, right? So,
Okay, so we need to do two motions per board, and the first to confirm the board's compliance with Chapter 2023-28. Is that how you
So-
want?
Yeah, so if you want, the first motion could be authorizing Dustin as your plan administrator to go ahead and file the report on each of the board's behalf.
Okay. We'll just take these one at a time. Huh? Do we need to do, yeah, we need to do it today, 'cause it's due. Okay, so the first motion is to authorize, Dustin to file the report on the board's behalf. So let's start with Lise.
So moved. Second.
We have a motion and a second. Any discussion? Roll call?
David Cohill,
Yes.
Marvin Dupree,
Yes.
John Costello.
Yes.
Motion carries. Firefighters.
So moved. Second.
We have a motion and a second. Any discussion? Madam Clerk, roll call.
Gaylord Candler,
Yes.
Ed Dawson,
Yes.
Lance Huish,
Yes.
Motion carries. General employees.
So moved. Second.
We have a motion and a second. Any discussion? Madam Clerk, roll call.
Nick Curry,
Yes.
Christine Hoffman,
Yes.
Eddie Badara.
Yes.
Motion carries. Okay, so the second motion.
Okay, the second motion would be certifying the board's compliance with Chapter 2023-28 and authorizing the filing of the report accordingly, subject to final legal approval.
Instead of me repeating that, you just want to say so moved?
So moved, not when you're repeated.
Huh?
Not yet.
It's here.
Dupree was.
And Dustin, I can help you with the language after, the minutes or whatever.
Please do.
I mean, it's all the words are here. Yeah. Okay, we have a motion by Cohill, second by Dupree. Any discussion? Madam Clerk, roll call.
David Cohill,
Yes.
Marvin Dupree,
Yes.
John Costello.
Yes.
Motion carries. Firefighters.
So moved. Second.
Motion by Candler, second by Hewish. Any discussion? Madam Clerk, roll call.
Gaylord Candler,
Yes.
Ed Dawson,
Yes.
Lance Huish,
Yes.
General employees.
So moved. Second.
Any discussion? Madam Clerk, roll call.
Nick Curry,
Yes.
Christine Hoffman,
Yes.
Eddie Badara.
Yes.
It's been a long morning, guys. Motion carries. Anything else? Pedro?
Oh, I'm sorry. So the only other item I had was, and I just don't recall off the top of my head, but we did also provide an additional memo that we were recommending to be sent to each of our investment managers, each of the plan's investment managers that have a separately managed account. So not, if we're in a commingled vehicle, a mutual fund, an index fund, and, obviously any of the real estate or alternative funds would not apply. But any manager where we have a separately managed account, we recommend just sending them that notice as well. And again, it's probably overkill, but this way, not only contractually, not only via the investment policy statement, but now they have a third essential notice from the board in terms of the new requirements of the board and of them, right, of the respective manager as to each year. And there's no action needed by the board, really just, I think, consensus or authorizing Dustin and staff to go ahead and send that out. No formal motion would be needed.
And I can actually jump in. As a firm, we've already done this. It was completed last week. And we're requiring them to confirm receipt, acknowledge it, and we'll keep that in our systems. So if an auditor or anybody else ever wanted to see that on behalf of your plan, we'd be happy to provide it. Again, we don't think it'll be necessary, but we will have it in case it's needed.
Okay, great, perfect, thank you. Okay, and then the only other item I kind of wanted to discuss, and I know there may be some discussion later with the police board, but for all three boards, obviously this is the gift giving season, or at least the beginnings thereof. So we usually take this opportunity to kind of refresh the board's memory with respect to their obligations, trustees' obligations under the state ethics laws. And so by virtue of your service on the board, you are considered a public official, technically. And so in terms of accepting, receiving gifts, you are subject to some certain requirements, right? So just really briefly, anything that's given to you valued at $25 or less, you can accept it. There's no reporting requirement. Anything that's provided to you valued between $25 and $100, you can similarly accept it. However, there is a reporting requirement on behalf of the person, company, entity that gives you the gift, right? And they need to file a form with the State Ethics Commission accordingly. And then lastly, anything valued at $100 or more, you should not accept it, and you should either return it to sender or donate it. And then we also do recommend filing a form with the Ethics Commission, just simply advising that you received the gift, who gave you the gift, the value of the gift, and ultimately the disposition of the gift, right, what you did with it. And then, does anybody have any questions or anything on that?
Nope.
You guys are all pretty varsity at this point. Okay, good. And then finally, just historically, we have provided holiday gifts to our clients. However, when COVID hit, I guess a few years ago now, we had to pivot away from that. It was a bit of a logistical nightmare, if you guys recall. So we started making a charitable donation in each of our clients' names on their behalf. And so if you guys are comfortable with that, we'd like to continue that this year. And so we'll be making a donation to local food banks around the state. If you guys are okay with that, that's kind of our intention.
Sounds good to us. Thank you.
Okay, great. And that's it. That really concludes my prepared remarks. Unless you guys have any questions or anything with me. And like I said, I think there's an additional item on the police side that I'm happy to stay on and speak on later.
Thank you.
Thank you.
Remember that Seinfeld, the Human Fund? Anybody, Seinfeld? No?
Yeah.
He made his all Christmas donations to the Human Fund. Anyway, lost on this board. Congratulations, firefighter board. Almost, you guys, I think it almost counts for perfect attendance, so well done. The fifth was here. I had to leave for.
Oh, well, I'm glad I got here.
No, you were great. We had fun. So, moving on to new business, General Employees Board of Trustees. We have some retirement applications. The first one is to approve the application for a backdrop retirement. Anthony Nichols, Public Safety Communications Officer, believe effective 9/1/2021. Separation date 1/19/2024. Meets age and service requirements for normal retirement, 20 years, and 9 months of service. Do I have a motion?
Motion to approve.
Second.
Motion by Curry, second by Vergara. Any discussion? Madam Clerk, roll call.
Nick Curry,
Yes.
Christine Hoffman.
Yes.
Eddie Guerrero.
Yes.
Motion carries. Item 2, to approve the application for backdrop retirement George Fryer, FOG Program Coordinator, Public Works, effective 2/1/21. Separation date 1/4/24, meets age service requirements for normal retirement, 33 years and 1 month of service. Is there a motion?
Motion to approve. Second.
Motion by Curry, second by Vergara. Any discussion? Madam Clerk, roll call.
Nick Curry,
Yes.
Christine Hoffman.
Yes.
Eddie Guerrero.
Yes.
Motion carries. Next item is to appoint a 5th member of the City of Jackson Beach General Employees Retirement System Board of Trustees for a 2-year term commencing 1/1/24 and expiring on 12/31/25. The 5th member is currently Brandon Maresma, whose term expires 12/31/23. You have Brandon's application. He is interested in reappointment, and there is a second application in there. I think it was Mr. Patrick. So if anybody wants to make a motion to appoint a 5th member?
There's a third in there
Oh,
as
sorry.
well as Laura Tierney.
Oh, Laura Tierney. So we have 3 eligible.
I'd like to make a motion to approve Brandon Maresma.
We have a motion by
Fifth member.
Curry. Is there a second?
I'll second it.
Second by Vergara. Any discussion? Madam Clerk, roll call.
Nick Curry,
Yes.
Christine Hoffman.
Yes.
Eddie Guerrero.
Yes.
Motion carries. Congratulations, Brandon. We'll tell him next time we see him. Moving on to election of officers. If somebody wants to just nominate a slate, that would probably be the easiest way to do it.
At the, after the applications, you can see who's currently in each position. Dan Jansen is Chair Pro Tem, Nick Curry is Secretary, Brandon Maresma is Chair. Just for
Sounds pretty
reference.
good to me.
So moved.
Anybody want to,
Motion to keep officers as is, or re-elect current officers. Second.
there's a motion and a second. Any discussion? Madam Clerk, roll call.
Nick Curry,
Yes.
Christine Hoffman.
Yes.
Eddie Guerrero.
Yes.
Motion carries. Okay, police. We have an application for retirement of Gregory Gordon, police officer, backdrop retirement effective 3/1/23, separation date 10/20/23, meets service requirements for normal retirement, 17 years, 8 months of service.
So moved.
Motion by Cohill,
Second.
second by Castilla. Any discussion? Madam Clerk, roll call.
David Cohill,
Yes.
Marvin Dupree,
Yes.
John Costello.
Yes.
Motion carries. Item 2, approve application for backdrop retirement. Tracy Hawes, police officer, backdrop retirement, effective 2/1/23, separation date 10/30/23, meets service requirements for normal retirement, 21 years, 0 months of service.
So moved.
Second.
Motion by Cohill, second by Castilla. Any discussion? Madam Clerk, roll call.
David Cohill,
Yes.
Marvin Dupree,
Yes.
John Costello.
Yes.
Motion carries. Approve application for backdrop retirement. Horace Engel, police corporal, backdrop retirement effective 1/1/23, separation date 12/11/23, meets service requirements for normal retirement, 29 years, 1 month of service.
So moved.
Second.
Motion by Cohill, second by Castilla. Any discussion? Madam Clerk, roll call.
David Cohill,
Yes.
Marvin Dupree,
Yes.
John Costello.
Yes.
Motion carries. Election of officers.
Make a motion to nominate Jason Sharp, chairperson, Marvin Dupree, chairman pro tem, and myself, secretary.
Second.
Any discussion? Madam Clerk, roll call.
David Cohill,
Yes.
Marvin Dupree,
Yes.
John Costello.
Yes.
Motion carries. Item 5, discussion possible financial split of the 3 boards on 10/1/2024.
So, I was gonna let Pedro kind of weigh in there on, last time there was a little bit of a question on whether the boards could individually vote to separate, or if they needed all 3 boards, or what. I just kind of took the information that was provided last time, and included that in the memo, here, just to kind of continue, the discussion, and, let Pedro
maybe the best thing to do, I don't know if you've had a chance to look over Dustin's memo, but essentially, I think the short answer is the boards have autonomy to either meet together or meet separately. The boards similarly have the same autonomy to either utilize the same managers and custodial bank service providers or not. They can choose to have separate managers, separate custodial banks, separate professionals, actuaries, attorneys, financial consultants, whomever. The board, obviously within this, there's I believe, and obviously our consultant can speak to this better than I can, but I believe that there are economies of scale in utilizing, kind of the same providers, right? And the same, I think, holds true for investment managers, for example, with potential fee discounts or fee breaks, depending on total asset size. The custodial bank would be in the same position where the assets are essentially aggregated. And so for purposes of any kind of fee discounts or fee minimums, right, for certain products, those could be satisfied easier with utilizing all the boards or two of the boards rather than individually, but that's not legally required, right? These are all just choices, business decisions ultimately that the boards are free to make. And I think there was also a question, just let me speak to in terms of if there's a lack of a quorum by one board, what the effect of that is on the other boards that have their quorum present. And essentially it would just mean that, and I think we've done it here, where any of the boards that does not have a quorum, right, would need to meet, establish a quorum, and then, obviously take care of whatever business is needed that perhaps the other boards were able to take care of at the initial meeting. So the fact that one board, if you're meeting jointly, does not have a quorum or can't take any action, doesn't preclude the other boards that do have a quorum from proceeding and carrying out their business routinely. So I think the short answer is it can be done. There's no legal obligation that plans meet jointly, and so really it's just a decision that the board should make and has the authority to make.
Okay, I will also add that I spoke with the actuary, Brad Armstrong, and he said that there would be no changes to the assumption, so it would, whether the funds were split or whether the boards met separately, would have no impact on the actuarial reports, but may have a slight impact on fees. But that's kind of what we expected, but it was good to get that confirmation.
Your fees went up too, based on that memo that we got from Dustin.
Yeah, I mean, it kind of depends on what does a split look like? If you're still meeting in close proximity, or if one, they're moving around completely different dates and it's just more logistical, there is a little bit of an increase, but it also depends on what that form actually will.
Well, I'm not trying to beat you up, I figured there'd be more.
Yeah, but that's, I mean, in
And
the
if we
grand scheme
truly
of things,
meet
I don't think
separately,
it's-
you're gonna have to do this 3 times.
Right.
I knew there would be a charge.
And there's, the other side is, when you go through normal rebalancing, if we are, as a plan, are rebalancing, say, 2 managers it's one letter it's 2 transactions. If you split into 3 separate boards, to do the same action requires 3 letters with 6 sets of movement or 6 managers. So there's just more involved, even though they're roughly the same action.
Well, being a closed plan, I can't, anything that's gonna cost us more money that doesn't really benefit us, I can't see that we need to do that.
I can't see any benefit.
I just think she just said they're a closed plan. There's the benefit right there. We're both open. We have completely different long-term. They're not adding any members. I'm adding members every day. They're adding members. I think that's the benefit, is that the plans themselves are now, we're relatively close, but over time we're going to be even more and more divergent.
Is there any changes you've made to the plan that they don't want?
make money, whether it's for the ones that remain in ours or if it's.
No, I agree. I just think that, again, there's 3 boards. We all have different sets. We all have different funding ratios. I mean, to say that we can continue to be this collective, I just, the reason I asked for this to be on the agenda was just to continue the discussion. I just didn't want to put to bed last time.
Oh,
That was all. I'm not saying vote, I want to continue the discussion, hearing from Brendan, get the input from all the boards, and make sure that, I see now we've got something in front of us on the investment policy, but just to make sure that I'm acting in the best interest of my members.
well, and this thing about a quorum, I've been on one of the other boards for probably 30 years. And the fire department has had an issue with it, but the police department for a long time had an issue because you may even know that. So it just depends on the folks that are on the board, whether they suit up and show up or not, so.
And I don't think it's fair to put the general or fire, if a previous police board couldn't fill a quorum, why should you guys be handcuffed?
Well, that's kind of the nature of the beast.
Well, I think there's some internal things that we can do to encourage better attendance. I know there was a scheduling issue with our active firefighters. I
Yes.
think that Dustin sent us 5 reminders. That's helpful. But I think that what I heard Pedro say is if there is something that requires a vote and one of the groups does not have a quorum, that they need to hold another meeting.
Well, that's what we did the last time.
We did.
Yeah, so I think that's, to me, I would do what I could to make sure we have a quorum at the existing meeting versus trying to schedule a special meeting for the board. So I think that we all just need to have that mentality of get to the first meeting, let's get the business done. As we continue to meet collectively, get it done collectively. I also, I kind of flippantly mentioned this before the meeting started, but as we're looking at membership on these boards, and I think your members that appoint people to your respective boards, we should be looking at attendance. And if we have an attendance problem with individuals, then I think that we have qualified applicants and interested individuals across all 3 of our boards that we should be considering that.
Well, I'll
so that we can-
apologize for any time for being late today, but I haven't been getting any communication from anybody. I didn't even get anything this time. So I called Dustin about it. I don't know if it's an email problem. I gave him a different email address, so we'll see if maybe, and they had an old phone number from 10 years ago. I don't know how that got on there.
Well, that's it. See, we can resolve that right now. Communication issue with that, and thank you. And
I
I'm
had
joking
changed
around,
all
but
that.
thank you guys all for being here.
I had changed all that. and
Regular.
Dustin had even called me a few times on the new number. I don't know, it was strange.
I normally just blame IT for these things, so just blame IT. They're not good.
No.
Don't tell them I said that.
She's not over at you anymore, so.
So I think it's interesting to see what the implications are of this. I don't hear a consensus to take any movement at this point. We're just kind of watching it, gathering
Again,
information.
I knew there were some questions that were left from the last meeting, which is the first time it was brought up to any of the boards. And I just didn't want it to fall off because one of the things that was brought up at the first meeting was trying to do the timeliness of it at the end of the fiscal year, if there was going to be any movement. So just continuing the discussion.
Everybody feel like they have the information they need at this point?
I think it was good that we learned from
Mhm.
Pedro this meeting that you aren't prevented from taking action if there isn't a quorum. You can go ahead and take an action and then have because we knew we could do that on other items like, the investment reports and the normal business, but like new actions that were taken, we kind of had taken the policy of we weren't taking action on.
We were waiting a whole other
movement
quarter, which I
funds.
get that's a long time.
Exactly. So that helps also.
Okay. Moving along, item C. Firefighters, slate of officers. Would anyone like to propose a slate?
Who's on there now?
It's in here, let me.
Chair,
Chair.
Pro Tem, and John is the secretary.
Make a motion to keep the same.
And I'll second that.
We have a motion by Hewish, second by White. Any discussion? Madam Clerk, roll call.
Gaylord Candler,
Yes.
Ed Dawson,
Yes.
Lance Huish,
Yes.
Motion carries. Is that everybody? You did yours, Candace?
Yeah. Debbie White,
Yes.
That's everybody? Okay, item D, consultant reports and presentations. We have a presentation from Allspring Domestic Equity Portfolio.
However they want to do it.
Everybody has a paper copy. Try to operate that, but I can almost guarantee I'll mess that up. Well, good afternoon, everyone. Nice to see you again. It's been time I haven't seen some of you at the conferences, but we were trying to remember the last time we were here, and it's been years. So I'm Dan Smith. I'm head up client relations here in the state of Florida. This is Bobby Chen with our investment team. Appreciate the opportunity to meet you today. Wanted to just come in and give you an update on what's going on with us. Hopefully there's no one here who's saying, who is Allspring? But hopefully you've heard from us. We were formerly Wells Fargo Asset Management. Just give you a quick kind of high-level overview of our last 2 years. So in November of 2021, we separated from Wells Fargo, became an independent asset management company, moved our headquarters to Charlotte, North Carolina. We are jointly owned by GTCR and Reverence Capital, private equity shops out of Chicago and New York. And the employees have taken about a 20% ownership stake in the company. So it's a great opportunity for us to separate ourselves from Wells Fargo, really kind of focus in on the investment side of things that we do, and away from the banking mess that we lived with for 5 years. We've had our last 5 years as well. So the firm is stable. All right. Assets of the firm have remained stable. As of 9/30, about $550 billion in global assets under management. From an organizational perspective, we recently announced Kate Burke has joined the firm as president. Our firm is currently headed up by Joe Sullivan, who's the CEO and chairman of the board. He has brought Kate on to take and kind of continue our journey down as an independent company. She joined from Alliance Bernstein, and that's kind of an ongoing process. As part of our separation from Wells Fargo, we are at setting up our organization. We established what's called a transition service agreement. That allowed us to kind of piggyback on Wells Fargo's technology capabilities while we're setting everything up. It's about a 2-year process. Happy to say we're about 60% transitioned off of that agreement. Our goal is to get completely separated from them by the middle of next year. That appears to be moving along nicely. So, and then let me just pause there. Any questions about kind of the firm before we kind of dig into the investment team? Okay. So I want to talk to you today about our dynamic growth equity team. Very much appreciate about 9 years, going on 10 years of working with you with our premier large cap growth strategy. Been maybe live in interesting times. The last 2 to 3 years has been a very interesting time in the investing world, to say the least, in particular for growth equity investors. So we just wanted to come in and talk to you about what's going on in the markets, what's happening in your portfolio, some of the securities that we're owning, answer any questions that you have. Please feel free to stop us along the way if something comes up. If you'd like us to zig and zag in any way, we thought we'd spend 15, maybe 20 minutes with you if that works. If you'd like us to go shorter or longer, we're happy to do that as well. So pause real quickly. Any questions? Any directional? Okay. So let me hand it over to Bobby. We'll talk a little bit about the investment team and what's going on. And
Great. Well, thanks everybody. I understand these are not, you guys normally don't hear directly from managers, so we certainly appreciate the dialogue and please interject, make the session as useful to you as possible. As Dan said, we certainly appreciate the long-standing relationship, appreciate having you as a client. And frankly, we're here because the last few years for Large Capital has been bit of a struggle for active managers. We're lagging the benchmark, even though, honestly, for this year, I'm talking more real time through today. Today is a big day in the market, but your portfolio is up about 27%. So certainly it's been great returns on an absolute basis. However, we are behind the benchmark, and I would be the last to come here and make a bunch of excuses, but I think there are some important contexts around the market that's unique to large cap growth, as Dan alluded to sort of keep it short. We have a lot of these conversations with Brandon and all the folks at Anchor on a continuous basis. If you look at the overall equity market this year, it is almost entirely driven by a handful of stocks. Just the ones that you probably all know, 7 stocks in the growth universe, makes up roughly 46% of the benchmark. The top 10 is 50%. So when you buy a benchmark, say the Russell 1000 growth, in theory, it's highly diversified. It's over 460 stocks in the benchmark, but 10 of them is more than half. So that level of concentration has never happened before. It does limit the opportunity if only a handful of big stocks are moving. So this year, as I mentioned, the Magnificent Seven, as many are calling it, it's really Apple, Amazon, NVIDIA, Tesla, Facebook, and Google, and Microsoft. So those are the 7 stocks that are driving a lot of market returns, and that's limited the opportunity, especially for your portfolio. So maybe let me step back and utilize the both and give you a quick overview of our business and our process, then we can get into the market, and I'll highlight some of the key things that we want to discuss. So if you flip to page 4, it's a summary of our team's book of business. So as Dan mentioned, we manage growth equities and growth only. So we manage portfolios up and down market cap, including small, all cap. The portfolio that we manage for you is called the Premier Growth Portfolio. It is one of 2 large cap growths that we invest. And how we differentiate versus the benchmark is that we typically are a bit overweight to the mid cap, the smaller end of that larger cap index. And the reason we do that is historically, we find that balance to be more additive to returns. Returns over time, believe it or not, does not come only from the handful of top names. Over time, mid caps actually have better absolute returns over the long term. So that balance that we try to strike, a lot of emphasis on diversification, and that's important managing growth equities because inherently it's a space that you tend to pay a higher multiple to own these stocks, and it comes with a level of volatility. So the way we try to offset and mitigate some of that volatility is really by being more balanced in terms of sectors, in terms of market caps, etc. Now, the last 3 years, 2021 and so far in 2023, has been all about mega caps. So in this environment, it is not entirely surprising that it would be a struggle for us. So in a way, being more diversified, greater emphasis on diversification these last 3 years has actually been the biggest hindrance to performance. So again, we're active managers, we're paid to pick stocks. Historically, that's what we do well. We have our history, you can see on the bottom of that page. Since inception of the Premier Growth Strategy, going back to 1994, almost 30 years at this point, we've annualized alpha or outperformance of 184 basis points annualized. So it's a really, really strong performance track record that goes back almost 30 years. But in the last 3, it's admittedly been a struggle because we've been more diversified in a market where only a handful of stocks are driving those returns. So if you look on page 5, quick recap on our investment process. We're firm believers in being very style pure. So what that means is when you invest with us for large cap growth, we want to provide that exposure consistently, meaning when markets are led by large cap growth, we are, historically, we've always outperformed in such space. So for us, it's really about adhering to that asset allocation intent of our clients, make sure we serve that purpose in their plans. And the way we do that is focusing on 3 key attributes for all the stocks that we invest in, what we call robust, sustainable, and underappreciated growth. So robust for us is really looking at top quartile growth relative to its industry. That allows us over time to invest in faster growth stocks. And the reason we do that is over the long term, the majority of the returns in those states tend to be driven by those faster growers. So that's why from a process standpoint, that's where we focus. And we like to invest in growth that's much more secular in nature. I think we're not economists. It's incredibly difficult to try to pick entry and exit points of businesses that are inherently much more tied to the economic cycle. So all else being equal, we want to invest in businesses that have good secular growth drivers behind it, that are growing above their peers. And then the last component of what's underappreciated is really valuation. I think that is an all-important component of investing that can never be overlooked. So what we try to do there is project the long-term growth of a company and then compare it to what the stock today is telling us. To the extent that we make an investment, we need to be able to see a gap in those expectations. So there are some stocks that are phenomenal growth stocks in the market. However, if the valuation is already reflecting all of that growth long term, it's inherently of less interest to us. So by marrying these key elements, we keep the portfolio very, in terms of decision making, very concise. And the turnover over time, we are long-term investors. Overall turnover of this portfolio is about 40% annualized over time. About half of that is on names, the other half is on traded on existing positions. So on average, we do hold these stocks long-term. Many of these big caps that I mentioned, we do own in the portfolio. We just don't own it to the extent that it is intellectual, and that's been part of the issue. And a lot of those we've owned since the inception of your portfolio. So when I say long-term, that indeed is what we do. And then lastly, is on page 6, the investment team is the portfolio management team is comprised of Tom Ogler, Bob Greenberg, and Dave Nasser. Worked together continuously since 2008, averages 17 years with our team, and about 25 years in the business. So highly stable investment team. We've had a ton of success in our history, and it's all owing to a process that we execute very consistently with the same investment team. I went a little quick there, so let me take a pause. Anything you have questions on? If not, I'm happy to talk a bit about the markets. Okay, so if we flip to the next page, this probably is the best way to illustrate it. When you look at the overall market, especially the large cap growth, it is a unique space in the concentration. So on page 8, you see on the year-to-date through the first 3 quarters, the mega caps of those 7 stocks I mentioned collectively up over 50%, whereas the rest of the stocks are only up 10%. These numbers have changed a little bit since. Actually, the margin might have widened even more. So when people look at large cap growth this year, they're looking at, the general comment is that there's been a really strong recovery off of last year. And it is true, but that recovery has been extremely narrowly led by a handful of stocks. And you can just think from an active and diversified manager's perspective, it's incredibly difficult to generate alpha when only a certain stocks are working. And when you talk about Apple and Microsoft, collectively, just those 2 stocks are over 25%, almost 25% of the weight in the benchmark. So we love those companies. Microsoft in particular, it does have a healthy weight in your portfolio. It's the top holding at almost 10%. Apple, given the growth characteristics, we don't believe it should be a 13% weight. We hold it at about 5% in your portfolio. Again, a very, very large weight already. It's just not at that 13% weight. So again, coming back to risk management and diversification, we're extremely mindful to keep that consistent with our process. So, but again, in this type of market, it's been quite difficult. And then if you look on page 9, it really shows that this concentration is a relatively new phenomenon. As recently as 5-6 years ago, you're really talking top 10 of the Russell 1000 growth. That's roughly 30% today. It's 53%. And the bottom line is the S&P, which shows there's level of concentration that's increasing, but the level of concentration is really a uniquely large cap growth problem. You have other managers in your plan, I'm sure, in large cap value. To give you some context, the top 10 of the value index is only about 20. It's less than 20%. So that's the weight of the headwind that we need to deal with in this market when it's driving, over 70, 75% of the returns from just a few stocks. That's an environment that's been difficult.
To put the concentration into a little bit of context for you, about 7 years ago, we had to come to all of our clients down here because most plans had a 5% max position size on any individual security. And there was one company in the index that was above 5%, it was Apple. But it started to grow so quickly and so much that we were forced to be underweight that by policy. So it's only been just a few years, and there was one instance of this concentration, and now the top 10 are basically all above that level of what we had originally set up as kind of a single security max position size. So it just goes to show you how dramatically different things have turned in a very short period of time.
And really to compound the issue, it's a very similar phenomenon that was observed in 2021, where larger cap outperformed small cap by 25% that year. This year, just to give you sort of real-time context through yesterday, the upper end, let's call it the mega cap, it's up 37%. The next tier would be larger cap, that's up 32%. Mid cap is up 10%, and small cap growth is actually flat, actually de minimisly negative. So it's outperformed by 30-some-odd% this year, on top of 2021 when large cap growth already outperformed 25. So needless to say, from a valuation perspective, we actually see this as a really good opportunity, down cap. And so the positioning of the portfolio, the fact that yours have an overweight to mid cap, we think long term is going to serve its purpose and really shine. However, in the interim, that has been the big headwind on performance. And a little bit of a busy chart I want to walk you through on page 11. I think hopefully this gives you some assurance that one, we're sticking to what we've historically done. Two, why we think the process is not broken or anything like that. So page 11 on the top graph, it's just a simple weight of your portfolio across the market cap relative to the benchmark. And you can clearly see we underweight the mega caps and overweight the mid caps. So again, more balance in your portfolio, but in a market where only mega cap is driving returns, that's going to be tough. But what's important is actually the bottom of that graph. You see the first bar, the dark blue, that is just the sector return differential between the weightings. So that tells you underweighting the mega caps cost the portfolio 117 basis points in relative returns, and then overweight mega cap or mid cap on the far end, you can see it's actually been the biggest detractor, 600 basis points down relative because of that differential. The second bar, the light blue one, is selection. That's stock measuring stock selection in the respective categories, and you can see most of those numbers actually positive. So that hopefully gives our clients some assurance that we did not lose our ability to pick good stocks, but when you're picking at different ponds and the differential is literally at the widest margin that we've seen in the last 25 years, that's a problem. So to summarize, 2021, 2023, if it ends today, will go down as the years where you see the widest disparity in performance between large cap growth and small cap growth in the last 25 years. So that is the obstacle for us in the current time, but it's also the opportunity that we see for all portfolios to actually do quite well going forward. And I'll flip all the way up to page 14, just to give you a sense of how the portfolio fundamentally is doing. So this is, we actually track the percentage of your portfolio that outperforms earnings, beat earnings expectations relative to the benchmark. So the blue bars are your portfolio, the gray bars index. Hopefully it's clear that historically we have a good batting average against the bench. And currently, despite the performance, that outperformance actually continues. So another way to think about it, if companies report their earnings, they're actually doing quite well. But that is clearly not being rewarded proportionally, because the performance of the smaller cap or mid cap stocks in the portfolio has really lagged. And then again, performance always looks the worst when your recent performance are weak. It drags on all the rolling numbers. But on page 15, it's important to evaluate the entirety of the track record, like I said, almost 30 years at this point. And we plot this on a rolling 5-year, meaning each dot represents a 5-year holding period in this strategy. And you can see almost 3/4 of the time historically, we actually outperform the benchmark. We're surely not in one of those periods, but hopefully this will convey that not only have we had long-term success, but we've actually had very consistent success over time. Obviously, no active manager is going to be able to outperform all the time, And we're in one of those difficult periods on a relative basis so far. And then page 16 just shows the power of compounding, what that annualized alpha over the span of almost 30 years. It's a dramatically larger outperformance, but admittedly in the last 10 years, it's been very difficult, mainly because of the last 3 years. And I know when people look at rolling 10-year returns, the question we often get are, well, why would I even invest in active? The reason is, that's what it looks like right now. On the trailing 10-year basis, active is, basically 90% of active managers have trailed. But it's not been every year, right? As recently as 2020, your portfolio had 40% return that year, 4 consecutive years of outperformance coming into 2021. So as difficult as the relative performance have been for the last 3 years, I just want to give you some assurance that not only is our track record historically much better, but we've actually been more consistent, certainly than what the current numbers show. And then if you flip ahead to page 18, that is your the account performance as of Q3. Like I mentioned, on a real-time basis, portfolio is up about 27%. Index is up about, call it 34 after today. So it's just immensely strong markets driven by a handful of stocks. And if you flip to page 20 and 21, you will see the portfolio both in terms of attribution from a sector and holdings perspective, and then you can take a glance at the top 10. Like I mentioned, we actually own many of these stocks. Microsoft is a 9.7% position. In the index is about 12.5%. Apple, like I mentioned, about 5%. Index is about 13%. So those are the differential in the weights. And you can see we have plenty of exposure. The names on top of the portfolio are phenomenal businesses. And I think, whenever I have these discussions, I want to make sure we don't become overly dismissive of these mega cap businesses, because they indeed are phenomenal businesses. They earn their way into your portfolio. Especially in the case of Microsoft, approaching $200 billion in revenue, and in the latest quarter, it actually grew 14%. So growing at a mid-teens type growth for a base that's that large shows just the power of that business, and with operating margins that are really the envy of all businesses at over 43%, it's actually really remarkable. So we like these companies. They are world-class businesses, and I'm sure you all have heard a lot about AI. They are the early movers in AI, well-positioned to continue to do well, but does it make sense for these to be, double, triple the weight that we have in your portfolio? We would argue not. And if you look in the top 15, 20 holdings in your portfolio, it really includes, a lot of phenomenal mid-cap companies, some of which you might recognize, like Deckers Outdoor. Many of you own sneaker brands, so you are familiar with like Hoka, very popular shoe. That is a Deckers Outdoor brand, along with Uggs. That has been a phenomenal performer in the retail space. Very strong outperformer, putting up the best top-line growth in the space. Or companies that maybe are less familiar to you, like Arista Networks, which plays a very critical role in AI and data centers. They provide, what's called Ethernet switches that really handles high-velocity data exchanges in data centers. So phenomenal, really strong companies that we expect will do quite well. But in the present market, a lot of these have been obscured by the fact that the attention and the performance is so narrowly led by just the top of the market right now. So
Pause there and kind of we're bumping into our time that I said here. I know you have a busy schedule of other things going on. So I want to leave you with a few final thoughts, but just pause real quickly when you have some questions. Anything at all?
Is there any chance this is like a systemic problem, like that the more people are passively investing, there's more retail investors investing in index funds, so now that's every dollar that's invested, 50% of it goes to the top 10 companies and it just kind of snowballs? I mean, do you see a turn coming in that, or what's your opinion on that?
yeah, no, that's a really good observation. We think about market structure a lot, and the research is very valid. I don't think it is So first of all, the big rule in anything, especially investment, is when someone tells you this time's different, be very wary of that close statement. We've seen markets before like this, right? Like in the late 90s, it was more driven by tech, more, not to this level. And if you go back even further to the nifty 50s and the 70s, you saw somewhat similar phenomenon. So, and we know how those ended, right? In pretty spectacular blow ups. So, I'm not saying that these are a company. I think there's some, we can get into a long discussion about why these businesses are stronger than today than they were. So we don't think it's going to completely blow up. However, the law of large numbers don't really seem to favor that these are going to exponentially grow at the rate that they are today. Meaning that as concentrated as these stocks are, it's hard to envision them, going significantly higher than the current levels because, ultimately to get to a market structure where a handful of stocks, say like 20 stocks or 70% of the benchmark, it's not a healthy market. So I think from a capital distribution perspective, it sucks out a lot of opportunities. So I think page 23 is part of the reason why we're much more optimistic. So from a valuation perspective, 2021, 2023, what's left is the way they interpret these charts is this is comparing each of these buckets and indices to its own history. And the higher the number means the higher the relative valuation to its own history. Meaning that if you look at the S&P at 83%, it means since 1998, so a span of 25 plus years, the S&P is only traded higher at 17% of the time, relative to say mid-cap growth, which is your portfolio having a bit more exposure at 21%. That means historically, 79% of the time, this index traded at a higher valuation. So this is why we're optimistic. I can't tell you the timing of a specific event that's going to turn it. And frankly, we don't need this to be a directional bet. The demise of, like the improvement in mid and small has to come at the expense of the demise of the large. I don't think it needs to be mutually exclusive. It's just that spread, that relative performance spread cannot be 30%. We've had markets where large cap has outperformed mid. In fact, that's happened more often than not over the last 15 years. And we put up phenomenal returns in many of those times. It can't be the single determinant of relative performance as has been the case for much of the last 2 years, or 3 years.
If the market doesn't correct the concentration, will Russell step in and change their weightings? And if they were to do that, what would that do to the Apples and the Facebooks of the world?
Yeah, no, that's a great question, and the industry, I think, is putting more pressure on Russell to revisit. So far, they've resisted those calls, but again, at a certain point when your index represents a wholly undiversified product, it becomes a big problem. So there's been more calls to review their methodology in terms of how they construct the indices, and if they change, mandates a certain cap, that's going to put immediate selling pressure because so much of the space has become passive. So those would be, I think, welcome changes in our view. I think the important thing is, for hopefully the takeaway for you is, from an investment process team perspective, we're doing things consistent with what we've always done, how we manage the portfolio. And two is that risk management and balance approach that we take. That is the hallmark of our long-term success. And despite the current headwinds that I discussed, we think clients would be wise to be patient and stay with this diversified risk management approach as opposed to just chasing the narrowly led market returns as good as they.
Unless there's any questions, we'll thank you again for your time, and we'll get out of your hair. It's nice to see you all again, and hope you have a wonderful holiday season. Thanks.
Yeah, we certainly appreciate it, and we're always at the ready if you guys have additional questions. We'll talk to Brendan and we'll solve it. Thank you so much. Thank you.
I'm the only one here that has to take that comment personally if I get out of your hair.
On that note, you're up.
Right. Did we get that?
I don't know.
Everybody has paper copies, so I can just go off that if that's.
was working earlier. I tested it before it started and it was working fine.
Oh, it's the way.
Yeah. Have a good one.
So let's go ahead and I'll jump in, I'll just kind of go off the paper, and then I'll have it over.
Yeah, they're trying to work on it.
Okay. So if you flip open, I'll try to just touch on some of the market environment briefly. You've already heard a lot of the commentary from Allspring about it. But on page number 4, just to give you a quick sense, and again, this is the September 30th fiscal year-end report. So this is kind of the important one for the year. Ultimately will feed into the actuarial report with Brad. But if you look in the upper right-hand corner, you'll notice we finished the fiscal year with a negative quarter. And the other thing I wanted to point out is just the parity in the returns. So whether it was the S&P 500 down 3.3, the Russell 1000 3.1, the MSCI ACWI was down 3.8, Bloomberg fixed income was down 3.2. So all of the major asset classes were essentially down the same amount, which is somewhat unusual. The only thing that made money was cash. So your decision a while back to rebalance and leave it in cash as opposed to fixed income or elsewhere did provide a minor benefit to the plan, with cash up over 1% just for the quarter. You can see down at the bottom right-hand corner, though, the last 12 months, it actually was a very good period overall for stocks. The S&P was up 21.6. Although, as you just kind of heard from, the smaller cap names, whether it's the Russell Mid Cap or the Russell 2000, which is small cap, you'll notice those returns, although positive, significantly less than the large cap space at 8.9 and 13.4% respectively. And then lastly, down at the bottom in green, fixed income, fractionally positive, 60 basis points for the year, but it was a roller coaster. We had some negative quarters, some big positive quarters, but we finished the year somewhat flat. And then the other thing I wanted to point out very quickly on page number 5, just notice the difference between the blue bars and the green bars. For the last 3 or 4 years, we've been seeing these huge swings quarter to quarter or year to year between growth and value. Last quarter, they were essentially down the same, roughly 3.1, 3.2%. So there was a lot of similarity in the returns last quarter as it relates to the growth versus value. Last item that I want to touch on in the market environment is on page number 11. And that's the yield curve down in the bottom right-hand corner. And what you'll notice in particular on the far right-hand side of that graph, the yellow line is quite a bit above the green line. So the longer term part of the curve, we saw a pretty significant jump in interest rates. And that is why we saw that negative 3+% out of fixed income. The Fed, yes, I think raised one time a quarter point, but the market was really reacting to a lot of the data and moving quite a bit higher on the long end of the curve. Any questions on anything I've covered or skipped as it relates to the market environment? All right, so let's go ahead and briefly jump on the asset profile of the fund. Page number 14, just sort of tracking the history of the asset.
Yeah, point it there.
Point it that way. Oh, I had it written. All right, so page 14, again, we show the long-term growth of the plan, also relative to the assumed rate of return, as well as the net cash flow along the bottom. So this is really a wonderful looking chart. We have the data going back to 1987 when you had $12 million in total. So now up on the far right-hand side, just short of $106 million. All the while, you've paid out all of that original $12 million plus an additional almost $39 million in cash flow. So you've roughly paid out $51 million off of your original 12, and you still have almost $6 million left in the system. So it really speaks to the power of the long-term growth and the compounding of returns in the plan. And then, of course, that compares favorably with the $100.7 million, which is the theoretically, if your assets had just been invested, earning the assumed rate of return for each of those years, you would have had $100.7 million, but your total performance is higher than that at the $105.6 million. You can see the asset allocation. A few different ways, but page 17 I like the best because it shows the deviation from our policy. And you'll notice we do have still a slight overweight to domestic equity as well as fractional to to international, underweight to fixed income, but that's kind of offset by the cash position. We've been reducing equity as we've been overweight, but not really putting it into much into the fixed income, keeping a decent portion of that in cash, and that certainly has helped, again, given the relatively low returns that we've seen the last 12 months out of fixed income. Just to give you a little bit of an update, so as of the end of the quarter, we were at 105.6. As of this morning, the plan was up to 106.6, so roughly $1 million higher in market value, and that doesn't include today, which the S&P 500 is up almost 2% today. So as we sit here, at 415, we're quite a bit higher in asset levels than what you're seeing here in the report. All right, let's go ahead and jump to page 21 and talk about the actual returns. Again, this is the fiscal year-end report. Upper left-hand corner, we were essentially in line with the index, down 3.3. Policy was down 3.32. For the fiscal year to date, or the fiscal year, most important number on the page, we were up 9.8% gross, 9.61% net. So relative to the assumed rate of return, it was a very good year. Nice recovery. However, on a relative basis, it was a little bit disappointing with the benchmark of 11.4%. We'll kind of get into that. Allspring is certainly a component of that. We'll see that in just a second, but as well as a couple of the other strategies. As you move farther out to the right on the page, just focusing on the universe, for the trailing 5 years, we're in the 45th percentile, so the upper half. The 7-year, 36th percentile, and 10-year, 32nd percentile. So well in that kind of upper half, if not the upper third of the universe long term. And I will kind of remind you, that's also with a relatively conservative asset allocation. There are a lot of plans out there that are 75, 80% plus equity and have fixed income, that's 10%, 15%. So in a period where we've seen a lot of volatility, and certainly equities generally have done well, to be in that upper third with that more conservative allocation is quite a nice outcome. As we move down the page, just to touch on, obviously you've got your Vanguard total stock doing exactly what it's supposed to. Allspring, who you just heard from, 18% for the year, which is a decent return. However, that is well behind the 27.7% of the benchmark. JP Morgan, our value manager, in line for the quarter, but they were also behind for the year, 9.3 versus 14. Since inception, they're relatively new. You hired them in 2019, still outperforming at 8.8 versus 8.3, but certainly the last 12 months did not help there. Eaton Vance, our small and mid-cap, our dedicated small and mid-cap exposure, very good quarter, as well as the year, 14.7 versus 11.28. But again, notice the difference, and it's really pronounced if you go out to 5 years. So Eaton Vance has done incredibly well. They've been a very good performer for you. They're up 7.5% versus their benchmark of 4.5%. But look at the benchmark returns for the other managers on that trailing 5 years. So small and mid has earned 4.5%. Value did 6.2, growth did 12.4, and then the blended benchmark for Vanguard did 9%. So just kind of further indication of how well larger cap has done more recently as compared to the small and mid cap stocks. One for some plans that are underweight small cap, I've been having a lot of discussions about considering rebalancing in given that kind of disparity, but with your Atlanta portfolio holding up as well as it has, and then you also have some small and mid-cap exposure with Vanguard as well as a little mid-cap with Allspring, I don't think there's really a need for us to consider kind of shifting anything within that equity space given how we're allocated. Page 22, we have our international managers, and want to highlight you have the new portfolio, the DFA value. We did not have it for the full quarter, but if you look on the far right-hand side, which you'll notice for the month of November, it was down 1.1% versus the benchmark of negative 3.1. And then also notice the returns of Euro-Pacific and WCM, both the kind of growth-focused managers, both struggled within the quarter pretty significantly, where a lot of that was in September. September was really the worst month of the quarter. So taking that money out, although the performance is down, you really mitigated a lot of that negative impact by pulling the money when you did. There was a big timing benefit there in terms of funding that value allocation to DFA. Again, longer term, Euro Pacific, WCM, still very good managers, even for the year, performed generally a little bit behind, but holding up better than certainly what they showed within the quarter. And then as we move down, we get the fixed income, last few pieces. Baird short term, 1% versus 73 basis points. Very good relative performance as well as absolute. Especially when you compare that to Sawgrass, that portfolio is down almost 3.7% for the quarter as we saw this jump in interest rates. But for the year, they've done relatively well. 41 basis points to the positive versus a negative 10 basis points for the index. So I think overall, Sawgrass did well, but you can certainly see the muted returns given the increase in interest rates. And then lastly, we've got PIMCO Diversified Income, -1 versus -3.5, and for the year, 7.25 versus 2.7. So a lot of relative performance there. And then the last item, or the last manager, excuse me, is the JP Morgan portfolio. Behind for the quarter, -3% versus about -2%, but are slightly ahead on the 1 year, down 12%. Benchmark was down slightly more than that. Tucked into your book, I did have a loose kind of page handout that I wanted to speak to for just a second. I think you've seen some charts similar to this in the past from me with relative to the equity market, the S&P 500. But we went ahead and put this together for the real estate portfolio, taking a look at prior negative periods in real estate. It looks like this. You should have it tucked into the front of your book. So really over the last 50 years, we've only had 2 prior periods of negative performance out of the Odyssey, the benchmark for real estate. The first one is that kind of dark blue line that kind of stretches across the top of the page back in the 1990s. That drawdown was roughly 15.5% over 11 quarters, or almost 3 years. So the drawdown that we're currently experiencing is getting pretty close in terms of the depth of that decline. We're at -13% through the last 4 quarters, so getting fairly close to the -15. But obviously, the difference is the duration. That one lasted quite a bit longer. It remains to be seen how long this drawdown lasts. But most of the managers that are indicating they think it'll be another 3 to 6 months, maybe 9 months before that kind of drawdown or difficult performance lasts within the current environment. Also in the red line, we contrast the other one, which is the global financial crisis. You can see that one lasted only 6 quarters. Much closer in terms of duration to what we've seen in the current drawdown, but obviously the magnitude of that decline was quite a bit more, down almost 39% over that 6 quarter period. So then the question becomes, what happens after these drawdowns? So if you flip to the next page, we kind of have a series of bar charts for each one of those periods. On the left-hand side, you've got the 1990s recession. Once we bottomed out, 12 months later, returns were relatively muted, only up about 3%. 5 years later, you are annualizing or averaging almost 9% a year. And 7 years later, you were averaging or annualizing at just short of 10% a year. So it took a few years to get there, but then in that kind of longer duration recovery, you were annualizing in certainly that 8 to 10% window that we expect out of real estate. The other drawdown, the GFC, had a much faster recovery. In the first year, we recovered 15.5%, and then the annualized numbers actually trailed off from there. But 7 years later, you were annualizing at 12.3%. Now, given the fact that the duration of this decline and the depth of the decline has been somewhere between those previous instances, my guess is also the bounce back in return will be somewhat, kind of between these. But if you, roughly average them, that means, you're in that 8 to 9% that first year. Obviously, only time will tell. But just wanted to give you a little bit of perspective as to kind of what has happened in the past with these real estate portfolios and how they've bounced back. Any questions on that? All right. Well, hearing none, that was really everything that I wanted to draw your attention to within the portfolio. On your agenda, we have kind of a discussion about asset allocation. Collectively, we're only about 2% overweight to equity, still fairly close to target. So from that standpoint, it's beginning to look good. About the only thing that I started to consider is, would we want to potentially start deploying some of that cash toward fixed income? Obviously, there's a question about, is the Fed done? Could rates continue to move higher? Or, are we closer to those rates? Have we reached kind of the max rate now, and potentially, as we head into next year, maybe even see some interest rate cuts? So if that was the case, if rates are going to stabilize and potentially move lower, then kind of taking some of that cash and maybe adding it to some of the longer duration fixed income makes sense. But also keeping it in cash and earning 5+% and not taking any of that interest rate risk has also served you very well. So I just kind of wanted to mention that. I don't think there's not an immediate need, but it is something to consider about maybe potentially moving some of that position kind of back towards some longer duration to take advantage, hopefully, of rates either stabilizing or even dropping.
Right. Go ahead. What's your recommendation?
I think I would go in, I'd probably do half. That's where I would lean, not necessarily do all of it, but start to take on a little bit more of that duration. Obviously, the Baird shorter term fund is a smaller step in that direction than cash. But even using the Sawgrass portfolio, I think makes sense.
The Baird is basically cash. I mean, it's
Correct.
Like 1 year, 2 year duration.
It goes out a little bit farther, but it is not dramatically different from cash.
I like the idea of extending duration. I think there's a much bigger chance we go down a couple percentage points in the next year or two than we continue to go up a couple percentage points. So I'm with you there. I think it's time we start extending duration. Not to move tactically, but we only meet once a quarter. We can't wait to pull the trigger.
Sure. Well, and again, it is a wonderful decision instead of adding to the fixed income 12 months and 15 months ago, keeping in cash has certainly benefited the plan greatly. But now it seems like we're probably near the top end of interest rates, so kind of extending out.
So where would you put it? In Sawgrass?
It would be the Sawgrass portfolio in order to take that duration risk.
I'm looking at page 22, and I'm looking at their relative performance. Lately, it seems like I see a lot of 80s, 60s, 70s. It seems like they're in the bottom half. Or
They are. One of the things you have to keep in mind is the A or better requirement on the quality. And there's not really an A or better universe, so that's a broad fixed income, which includes triple Bs and some lower rated bonds. And especially over longer periods, you're getting higher returns out of those. So part of that lower universe percentile has to do with the quality restriction.
is that our restriction?
It's in the ordinance.
And we can't invest anything below?
A-rated bonds.
So kind of the way I look at it,
Why is that in the ordinance?
I can't, I mean,
Reduce risk.
I'm not exactly sure what the reasoning at the time that was put in. So I'm sure there was just some fear based around lower rated bonds when that was put in place.
Sounds like something they put in back in the 70s or 80s when it was written.
Probably was.
Is there somebody besides Sawgrass that can meet our investment policy?
There certainly are other managers that do operate kind of in a similar fashion. It's not a huge number that kind of limit to A or better, but there are strategies. But I'll tell you, one that we work with quite a bit in Florida that also does A or better has not performed, as well. Now they're very active as a manager, so they take a lot of duration bets, and they are expecting interest rates to be low. It's Garcia Hamilton. It's probably one you've seen at other conferences and things like that. And actually, even the operating portfolio for the city has them in a short duration portfolio. But they're expecting rates to come in quite a bit. So they've extended the duration of their portfolio, and this quarter, they looked dreadful. I mean, they were down, 1.5% beyond what the index was because of that duration. But yeah, that's one example, and then there are others that do it as well. But I mean, on a relative basis, Sawgrass has been outperforming. If you look, whether it's the trailing 3-year, 5-year, 7 years, essentially spot on, but 10-year, I mean, they've generally outperformed. It hasn't been by a significant margin, but relative to that A or better benchmark, they have outperformed. But it is in the lower end of the peer group because of that narrowness of the play.
Yeah, so it doesn't sound like they're the problem, it sounds like the restriction is the problem.
So, I mean, again, we've had discussions about trying to broaden the ordinance, in the past, and certainly we would be supportive of having more options at the board level. But until that is done, the most important thing is the duration profile. It's going to matter less about the triple Bs versus single As or double As on the interest rate discussion. That'll be a relatively minor part of it. If interest rates move, well, even if they stabilize, extending duration, ultimately, benefits. Certainly, if interest rates begin to decline, then you really see a potential bump. So the number in cash is 4.2 million, 4.19 to be exact. So if we're moving half, just a round number, call it $2 million. If you like that number, potentially moving that again. Baird is fairly close to cash. Sawgrass obviously is the longer one. Or certainly we could split it too. Maybe we go a little slower, do $1 million at a time. Maybe revisit it each quarter. Does anybody have discomfort with the idea of moving $2 million back in?
It was a little scary moving to a fund, losing money.
Well, do you have any of the
A while.
statistics on Sawgrass, their duration,
I don't think we
yield
include
to
that.
worst, any of that?
No, I don't have that in here. We'll certainly provide that for you though.
I'm pretty sure I know about what it is.
Mhm.
It's 6-year duration and probably a 7% or 8%, yield to worst. It would make you feel better to know that, yeah, if interest rates go up, we'll get a little bit of a dip, but we're locking in really long-term yields for the next 8 years. Now, could we wait, if we time it perfectly, could we wait 6 months and lock in a slightly better yield? Yeah,
Crystal ball.
but again, I'm not a weatherman.
Well, and again, we didn't know how far rates were going to be rising when we were making this decision,
No.
keeping it in cash. So it's just a matter of heading in that direction.
That's what I say, don't be greedy. Let's just, we got it, we got one, we got to win, let's lock it in.
So we've been taking a measured approach for a number of years now, and that's why I think half of it makes sense. But if somebody wanted to propose a different number, I'm not going to argue against it.
No, I think that's what I was saying. I'm agree with you. 2 million into the Sawgrass one.
And in the Goldman Sachs money market, is that cash is in it currently?
Correct.
Is that a variable rate on return, or is that a fixed 3%, 4%?
It's earning north of 5.
Okay.
But it is, if the Fed cuts rates tomorrow by 50 basis points, 2 days later, essentially the yield on that's dropping by 50 basis points. Think of it that way. It is variable to the extent that interest rates are being adjusted. So it's great now that you're getting that yield, but it may not last.
Right.
So that's the question. You give it to a Sawgrass who goes out and buys a 10-year bond or an 8-year bond that's going to pay you 5 or 5.5%, and if rates decline tomorrow, you're still getting that 5.5% yield for the next 8 years.
Any other thoughts on that thought of moving cash to Sawgrass? Any other discussion or questions? We ready to take action? John, do you want to propose a motion for
I make a
the
motion, we move 2 million from cash into Sawgrass.
Second.
We have a motion by Gastillo, second by Koval for the police board. Any discussion? Roll call.
David Cohill,
Yes.
Marvin Dupree,
Yes.
John Costello.
Yes.
Firefighter board?
I move that we move $2 million from cash to Sawgrass.
Second.
Motion by Candler, second by Hewish. Any discussion? Roll call?
Gaylor Candler,
Yes.
Ed Dawson,
Yes.
Lance Rush,
Yes.
Yes.
Debbie White. I am so sorry, Miss Debbie.
Please let the minutes reflect that
Debbie
White
is
in
here.
attendance.
She is here.
General, please. Fight for it.
Motion to move $2 million. I'll second.
We have a motion by Vergara, second by Curry. Any discussion? Roll call?
Nick Curry,
Yes.
Christine Hoffman,
Yes.
Eddie Vergara.
Yes.
Motion carries. Okay. So that takes care of rebalancing for us.
It does, and that's everything that I was planning to cover in the quarterly report. Do you want to, something, do you approve that by motion? Do you want to
Yeah.
finish that before we talk about the IPS?
Yeah, and I do want to say, I mean, this is the second time in a couple of weeks that the bond reading kind of penning us in has come up. So I just want to think about that. If that's something we need to look at in the ordinance, I mean, if it's penning us in to a point where the city council needs to consider it, I think,
Okay.
just keep an eye on it.
If we're gonna talk about that and open up that bag, I'd really like to open up the bag of alternative investments, just wide open. If you look at any endowment fund, any sovereign wealth fund, like the Yale Fund, back in '85, when this was started, they were at 85% public equities and publicly traded debt. Now they're at 90% the other way. So these aren't, stupid people. They crunch the math, and you can go and they have a beautiful website if you want to go and do a quick, research on it. But it's becoming really popular, and they got a really good argument for it. So I think, allowing us that flexibility and those options would really improve our outcomes.
I'm not sure what the procedure for this would be, like how this needs to take place. I'm thinking maybe having something of a workshop for the pension boards, coming up with a letter that we would send or give to administration and the council, because honestly, we have to get administration on board as well with anything, because their administration is the one that has to take the council. And so I think the letter should probably be addressed to administration and council, and just need to have some kind of joint, it doesn't need to come from me, it needs to come from you guys, and then I'll be putting it together. But, so you want to put something together, maybe put something together, like a workshop for like January or something like that, early, I don't know, the holidays and stuff, or
Say
if you want.
February.
February,
It's already past January.
okay.
I mean, what a reasonable amount of time. And I mean, my point isn't that we have to take action, but I think we need to make sure we have the options available to us that we need, especially in this new and unique market.
I mean, the good news is, you've been very conservative for a long time, and you've performed well. You've beat your assumed rate of return, so it's not like this has held you back. But I think it's worthwhile conversation to just look at those options and consider whether making changes makes sense.
That's a reasonable outlook. Okay, so the ANCO consulting report, we need to approve. I think we do that by board. Police board?
So moved.
Second.
Motion by Cohill, second by Dupree. All in, roll call.
David Cohill,
Yes.
Marvin Dupree,
Yes.
John Costello.
Yes.
Firefighters.
So moved.
Second.
Motion by White, second by Candler. Roll call.
Gaylor Candler,
Yes.
Ed Dawson,
Yes.
Lance Rush,
Yes.
Debbie White.
That was a voice of God moment. Motion by Curry, second by Vergara. Can I just handle this for you guys?
Motion to approve.
Roll call.
Nick Curry.
Yes.
Christine Hoffman.
Yes.
Eddie Guerrero.
Yes.
So the last item I have for you is related to the IPS. We did a much bigger revision last quarter dealing with all the House Bill 3 and getting that up to date. In that process, essentially the day of the meeting, it came to our attention that there was one paragraph that dated back to like the 2009 policy that had disappeared. In one of the revisions, there was a change in format a long time ago. And so in all of the subsequent revisions, that paragraph had just continued to be omitted from the time that it disappeared. And so I wanted to bring that back for your consideration. It wasn't intentionally removed. And once we kind of figured that out, we wanted to put this back for your consideration if you would want to add that back to the policy. It's right there on the first page. It's essentially just a statement saying that all 3 boards have elected to pool your assets, essentially an affirmative statement, kind of, encapsulating your current arrangement. So again, if we were to change it and add that, it would need to be approved by motion.
How does that need to be stated? Because it's not really an amendment. It's just,
I mean, it would be up to approve an updated investment policy,
okay.
Based on that submission.
Any discussion or concerns?
Yeah, why did it disappear?
There was, so this is back with Troy Brown and Dan, they'd moved to a different format of the IPS. So when they made that change, they used kind of a new template, and they, for lack of a better description, they just didn't take, this is a custom sort of, inclusion in the IPS. They didn't take that custom language from the prior version, they just used a new template that didn't obviously have that. So just kind of an oversight in terms of that change.
Which revision was that?
I believe it was August of 2009, or
The last one we had,
it was a good while ago, and then,
15 years
right,
and 4 revisions.
correct.
Timing just seems off considering all the discussion we've had about splitting boards, dumping this language.
That's what brought it up. I mean, we didn't know. It wasn't included. That discussion went to us investigating, where is this language that says anywhere that our funds are held jointly? And that's when we found that it had previously been in the investment policy and had been inadvertently left out.
But I mean, we can't even go back to 09 minutes and find if it was taken out for purpose. That'd be beyond.
That is true.
Okay.
I don't
So it could have been omitted for a legitimate reason. And we have no way of knowing.
It's possible. When it came up, I was with Dan Johnson last quarter when this came up in a secret conversation, and he was the one that did it. And he effectively said, no, I think that was just an omission there. He did not recall any intent to remove it or change it. It was just kind of got lost in that, the format change. Again, it doesn't need to be there. You've been operating, this way collectively. So, it was one of those things that wasn't there in the past, and to the extent that you wanted to put it back, we wanted to give you that opportunity. And again, it's also something you could just as easily remove at a later date. Just putting it back in doesn't make it permanent. If that was a concern.
Any discussion or questions?
Yeah, Dustin, I got a question for you. I thought when we talked about this a while back, about the ranges that everything could be invested in, stocks and bonds, we came to the conclusion that this board doesn't have the authority to change those parameters. And then that's when I saw this language, I thought this would be something that would have to be taken to council. I didn't think this board had the authority to include language. So is this for us to approve to go to council?
So the ordinance has parameters that are like upper limits on everything. The board has the authority to set the ranges of the target within those upper limits. As far as I'm aware, this is kind of specifically within the board's, there's nothing in this that's outside of what's in
So if I could just jump in, that's exactly right. So the investment policy statement, that's strictly the board's purview, and you have obviously the right and the authority to change that based on discussions and recommendations with your consultant. The ordinance, and I think it was kind of brought up earlier in part of the conversation and discussion, the ordinance really mirrors state law to a great extent, but provides kind of the general framework in terms of what's allowable and what's not allowable. But then within those different, asset classes and things like that, and the range, right, the board has discretion to operate. But to the point that was made earlier in the discussion, right, so if you guys recall, the ordinance sets forth a specific rating for the fixed income for bonds, right? And so, in order, the investment policy has to conform to that. You can't go outside of that by your policy. So in order to change that, we have to amend the ordinance. And then similarly, I think one of the trustees raised the issue about potentially looking at alternative investments, right? So right now, your ordinance does not allow for investment in the alternative fields, right? And so, and neither does your investment policy, right? You couldn't make a policy or invest in amend your policy to create this as an asset allocation because it's prevented, it's prohibited by your ordinance. However, if you change the ordinance to allow for, let's say, alternatives or real estate or whatever the case may be, then you can go back and amend the investment policy to say, okay, we're going to allocate, and I'm just making this up, 5%, and it's going to, with a range of anywhere from 0 to 8% of the assets, things like that.
Did that answer your question, Nick?
Yeah, it does. Thank you.
Any other?
Pedro, is this language not in direct conflict with Florida State Statute 18505, which directed the assets to be split after July 199, or I'm sorry, October 199?
No, it does not conflict with it.
Okay.
Again, from my perspective, this doesn't need to be done, it doesn't need to be passed, but it came to my attention and I wanted to give you the opportunity to the extent that you were interested to put it back in the policy should you feel it was important to include it.
It reflects how we're operating, so if we're not gonna operate that way, then we can change it. Any other thoughts or concerns? Any boards wanna start off with a motion? To adopt the policy as revised, as we're saying?
Well, just for the sake of doing something, I'll propose that the firefighter board adds that language back into the investment policy statement.
Second.
We have a motion by Candler, second by Hewish. Any discussion? Roll call. Oh, sorry, yes, discussion.
Yeah, so if we vote in favor and another board votes against, then we're in that situation where we just have two different things. Is that a problem?
I think it would not be adopted. It is a joint
Okay.
investment
Right.
policy statement, so it would take all three boards.
Okay, good.
I think, right, so right now you have a joint policy, but, again, that's by design, it's not required. So if, to the point, I think somebody answered the question correctly, right? So right now, everybody would have to approve it. If a board wants its own policy, then that kind of goes back to the discussion we were having at the beginning of the meeting where we have to, that board would essentially have to kind of break off and create its own policy.
Any other discussion from fire? Roll call.
Gaylord Candler,
Yes.
Ed Dawson,
Yes.
Lance Hewish,
Yes.
Debbie White,
Yes.
Motion carries, please.
So moved.
Second.
We have a motion and a second. Any discussion? Roll call.
David Cohill,
No.
Marvin Dupree,
Yes.
John Costello,
Yes.
Motion carries. Is it carried? No? Because it's not,
I think you have all
it's gotta be three. Okay, motion fails. Gentlemen, please.
Motion to add the wording.
Motion by Vergara. Seeing no second, motion fails. So basically, we just don't add this language back in.
Correct.
Okay, so we.
It's the in effect, that's the policy you approved last time, so there's nothing needs to be done, nothing needs to be filed.
Okay. Back to the agenda, pension administrators report.
I think I'll just skip over the plan membership section this time. Nothing very notable there. Continuing education, the winter FBPTA conference, January 28th to 31st at the Rosen Center. Please send me an email if you'd like to go to that. I will forget if you just tell me. Software update, we actually have some movement on that now. Later this week, I will be sending out beta test emails to some general plan employees. Nick and Eddie should be expecting some emails to be a part of that. And then shouldn't be too long after that, employees will be up next. They said they're just not quite there on the police ready for beta. Yet. This does not include backdrop yet. They don't have that. So this is mainly just your verifying your data is correct and using current payroll data to do projections. And I really just would like everyone to go through the software as much. Try and break it. Just try and do everything you can. Click on things that you probably shouldn't be clicking on, and just see what happens. And that way we can report any errors or anything to Gilbert Smith and get it fixed for you.
I know you might not have it. Do you have a timeline? A lot of my members have been asking.
I ask them that every time, and they won't
Any day now.
commit to a specific timeline because they had given us a specific timeline before and missed it by quite a mark. So, sorry, I don't have a specific one.
That's okay. Appreciate it.
Yeah. I know I've received a couple emails from some of your guys that would like to be part of the beta test on that, so I'll include those members on that. Appreciate it. And we obviously just had the police and fire elections, and now upcoming we also have the council appointees, and the 5th member terms will be up at the end of March. So the council will be making their appointments coming up in the first quarter of the year, and in our February meeting we'll be making the 5th member selection.
They haven't changed that for 4 years, there's still 2.
I believe there's still 2, yeah. We changed the police terms to 4 years in the last. We're just kind of, yours is a 2 right now to get it on separate cycles. But that is the only thing that's been changed to 4 years. If we open up the ordinance in the future, maybe that's something we think about including.
Because every 8th meeting, you're swearing me in again.
Yeah, I know, it's a lot.
It's a lot.
One note that I don't have on here, the death audit software, you know, we budget every year for that. This year I think I budgeted the same $600, and then, which is what I thought it was going to be. I got a quote from previously. That company got bought by another company, and they said that quote's invalid, and then they said that it was going to be $2,000, which I thought was quite a jump from $600 to $2,000. So we went to another company. This PBI company has basically been buying up everybody who does death audit software. And so there's another company that was starting up and was in the process of their SOC 2 certification. And I was waiting on that to happen before I brought that to you guys for approval. During that time, when I just didn't respond to their $2,000 quote, they just sent me an invoice for $600. So
You were playing hardball.
So I'm just going to go ahead with that for the next year, and since we already have that in the budget and everything, and then I'll adjust the budget for next time. So I haven't done a death audit. I usually do those monthlies. I haven't done one for October or
working? Have you found any that?
Most of the time, it's only helped like one time. Most of the time, this is kind of a small community of people. Everybody
They know
knows the
everybody.
retirees, and so it's rare that I don't know before the deadline software tells me.
Yeah, they do
What's
that.
that
in-
work anyway?
What is it?
What's the deal?
It's like a national database. They basically just gather all of the obituaries from all over the country. It's like a data scraping software that scrapes the internet obituaries for names, dates, addresses, and all that, and then compares it to our list of retirees and social security numbers, date of births, and date of deaths.
We had an issue with that one time, remember?
Yeah, yeah, we did.
You don't have to try to go back and get money.
Yeah,
Yes,
a couple
we-
times. We haven't had to do that in a while since we
A
had.
lot more than $600.
Yeah.
Well, if you think about it, they mail you, it's direct deposit.
Yeah.
So if you die and your family, they have a joint account, they don't call you, you don't know.
Yeah, and used to, before we had the deadline software, our procedure was just to send out a letter to our retirees once a year and say, are you alive? And if they didn't respond, then we had to try and contact them, which is, they didn't like that either. So, the deadline software has been much better. Yes, so next meeting, there is one more item on there, right? The pension or the new meeting calendar. There was an error on one of the years. I forgot to change to 2024. Whenever I changed it, the dates got changed to the fourth Tuesdays, except for in May, I believe that was some kind of election day. The room was taken. I'm not sure if it was election. So the room was taken on a Tuesday night or Tuesday afternoon in May. So just move that to Wednesday.
Just be the primary.
Might be.
I just
Yeah,
mentioned
usually is the election.
that November meeting is the Tuesday before Thanksgiving. I don't know if that would be a problem for quorum people traveling.
What's your dates? Just read them off. What's the
What
dates?
changes?
Well, I got one very back. I thought you were saying something got changed.
No, the change is, what you have in front of you is,
Oh, okay.
is the change.
All right, stuff over there.
Yep.
You're saying that's the Tuesday before Thanksgiving?
Correct. Thanksgiving's the 28th, and the meeting is the 26th.
26.
Yeah, I have,
Is that,
but it just, in my experience, any meetings Thanksgiving week end up not happening for lack of a quorum.
okay.
But if you guys are good with it, then that's totally fine. I just wanted to mention it.
I'll be going, so.
I
Well,
would say we're to look at the calendars, it's a year down the road, if we have to change it next meeting, we can.
yeah, so maybe we can approve the calendar now, and I can come back with an amended calendar of the next meeting or something like that, if we want to do that, or what?
Would it make a difference if you move it like to the 19th, 1 week earlier?
No, I don't care. It's more, I think you have something on the third Tuesdays of,
Yeah, the 19th is a little bit of an issue for me personally, but if that's what needs to happen for you, we'll figure it out.
It's not affecting me, I'm just saying.
The 26th is great for me, it's totally fine, but
For me.
I just have seen it too many times where it ends up being a problem for the boards.
well, how about we just,
Can we approve all three boards together? Can we get a motion to approve?
Motion.
Second.
Motion by Cohill, second by Hewish. All in favor, signify by saying aye.
Aye.
Any opposed? Motion carries. Any other business? Alright. Did we do a motion to adjourn in this meeting? We added that to council. Let's just go do it. Is there a motion to adjourn?
Motion.
Is there a second? Cohill, Curry, all in favor, signify by saying aye. Aye. Any opposed? Meeting adjourned.
Have a good evening, folks.
Thank